You're listening to Pre-Market Prep. I'm Brianna Valesky here with Joel Elconin. We're on the line with Jeff Reeves. He's an executive editor of InvestorPlace.com. Jeff has almost 2 decades of newsroom and markets experience, including a stint as an editor for the New York Times, and he's contributed investing-related content for outlets like USA Today and MarketWatch. Jeff, thanks for joining us. How are you doing this morning?
Doing great. Glad to be here.
So we've brought you on to talk about IPOs, and we've had, in my opinion, what seems like a ton of IPOs this far this year, and it seems like there's been a lot of excitement surrounding them. To start off, I'd like to get your take on if you think we're seeing a bubble in the IPO market.
Well, I do think we're pretty darn close to a top. Bubble is a matter of perspective. I do think that there's probably some sentiment that can continue to lift and new issues that are out there. I don't want to get too much into the minutiae, but I think what we're seeing right now is this big push in late stage IPOs, and the problem with that is that the proponents say that these are companies that would have been public in the previous era, maybe in the 2000 tech bubble, and so it's really not that big of a deal if they're just going public later. But I think it's important for investors to remember that these are companies that were private before and didn't undergo public market scrutiny. So a lot of the time, they've kind of been going their own way, and they've been able to plot their own growth metrics. And then when they go public, the narrative is always really grand. Sometimes reality doesn't live up to the hype, and I think that that's what's really important, is to separate these companies that perhaps are a little bit frothy. They had a huge investment right before their IPO, and frankly, I think that there's just a lot of well-heeled Wall Street insiders that are just looking to get paid. Those are the ones you should avoid, and I do think there is kind of going to be a bubble in that, because we've squeezed about as much juice from that orange as we're going to get with some of the big IPOs we've seen.
What IPOs have stuck out to you so far this year? It's ones that we've been talking about a ton lately. Shake Shack is in the news a lot. Fitbit, Wingstop was pretty recently. GoDaddy, I think, was a couple months ago. Which ones have really been on your radar?
Well, I think that there's two stories. Fitbit and Shake Shack are good ones to kind of point out, because they've basically doubled since, well,
Right.
at least they've doubled from their offer price. But I think that it's a very different story when you see actually how the story the retail investors endure with this, because Fitbit offered it $20 ostensibly, but it never traded for that. It got its instant pop. Great for the insiders, but retail investors don't get to play that game. So I'm really watching these, because I think they're representative kind of what we saw a couple of years ago with stocks like LinkedIn, right? I believe the numbers for LinkedIn was it offered at 45 and it opened at 83. Nobody got a chance to buy it at 45 unless you were a company insider. And then you got a little bit of a pop, and then there's a fade afterwards. So I think that's kind of going to be the order of the day. I'm very interested in seeing how companies like Fitbit and Shake Shack are going to perform now that they're trading on public markets. It's not as important to me to see what happens to insiders who got to buy Fitbit at 20 and got that instant pop. I know Benzinga is all about individual investors, and Investor Place, we're the same way. We're about small-time people, not insiders. We want to see what it's like for normal people and how it trades on the open market. So I think that what's going to be telling is whether or not these paper gains that the insiders got actually reflect if the stock goes up based on where it started on the first trading day, not what its offer price was.
Are there any IPOs that you're kind of watching out for later this year? I know we're probably expecting a PayPal spin-off from eBay. Anything else that you're looking forward to going forward this year?
The one thing that I will say is that I am concerned, like I said, about these late-stage IPOs, companies like Alibaba that hit the market when they're already gigantic, and there's a whole lot of narrative behind it. But I am a big believer in biotech right now. I do not believe that we're in a biotech bubble.
Really?
I think that there is a lot of potential there for these kind of niche cures for orphan drugs. Not all these companies are going to work, but with a diversified portfolio, there's tons of ETFs out there that play development stage biopharmaceutical companies, and I do think there is a lot of potential in this batch of biotech companies that we see come out. They don't offer as large, and they don't offer with quite the fanfare that some of these big consumer names or tech names do. But if you look at some of the ones that have blown the doors off year to date, at the top of every IPO performance list, there's always companies like Summit Therapeutics is one that went public in March, and it's up over 700% since its IPO.
Right.
There's a lot of companies like that maybe you haven't heard of. And I think that they're certainly worth watching. They're riskier, they're a little more volatile, but I think as a group, there's not necessarily a bubble. If you play it in a diversified way, I think there's a lot of upside there.
What about investing in IPOs? Can you give our listeners a little bit of the ins and outs of that?
Yeah, so again, back to my earlier statement, I think it's important to separate narrative from reality, especially with these late-stage IPOs. The company hasn't really operated the way that it should in a public market. Twitter's a great example of that. They talk about their growth, but they didn't really have profitability. They don't really have a cohesive vision. There's slowing growth metrics on users and margins aren't improving. It's just a bad situation to be in. And if you actually took the time to look at the S1, that is the SEC document that a company has to file and as it approaches its IPO, you could have seen some of these trends. I think it's important to look at the actual documents and look at the numbers and not just believe the narrative. Similarly, I think it's very important to look at the lockup expirations. That's the date when company insiders can actually start to sell. And with these hot IPOs where a lot of people become paper millionaires, they want to become actual millionaires when they cash out their shares. Right. And sometimes that big buying pressure, when the first lockup date expires, they're allowed to sell on the open market. There can be a huge flood of selling pressure that affects prices. So I would say that, narrative is always important, especially in momentum stocks where sentiment matters. But I do think that it's crucial to actually look at the numbers. As Benjamin Graham likes to say, in the short term, the market's a voting machine. Long run, it's a weighing machine. I think you can maybe possibly swing trade IPOs out of the gate if you're really, really savvy. But for most investors, I would not play that game. I would look at the documents and think longer term.
That's exactly what I was going to ask you. We have some traders who are just like, I don't even want to touch IPOs. I don't want to go near it until I've actually, seen a couple earnings reports and actually have a little history. But you think with enough research, it's okay for the average investor to try and take their hand in investing in an IPO?
Yeah, and I mean, it is important to realize that, like I said, that you have to separate. In the long ago, it used to be that these were startups tapping capital markets the way that I believe capital markets were created to foster growth and innovation and to give companies the money they need to succeed. That's vastly different than an Alibaba, which was clearly just people getting paid, right? Alibaba doesn't need to raise money to grow. Or when Dunkin' Donuts hit the markets again, it's because private equity decided they wanted to cash out. I think those are very different stories. And say at Tesla, there were a lot of people who looked at Tesla and they liked Elon Musk. They looked at some of the numbers and were impressed with it, but they also liked the narrative. And if you bought Tesla, even in the first couple years after its IPO, before it went parabolic, it paid off. I mean, there's huge risk in startups like that, but there can also be huge reward. And I think that smart investors who identify the right companies can still ride that trend. It's a very difficult game, and I especially think it's difficult now that there's a lot of noise. Again, companies like Alibaba, I mean, I don't know how much upside there is. You're going to tell me a company that hits the market at $100 billion is going to go up tenfold from here? I mean, that's kind of crazy. So I think it's important to identify the different flavors of IPOs. And again, it's all about your individual portfolio and what you want to do. If you're in retirement, an income-oriented investor that's thinking about capital preservation, don't play that game. But, if you're in your 30s being a little more aggressive, there's nothing wrong with taking some shots on goal with a company like Tesla or those kind of biotechs that are coming out if you want to play them in a reasonably responsible way with a diversified portfolio. So I guess that's a short way of saying, or a long way of saying, there is no universal truth here. I think it is specific to what your goals are as an investor. There might be people who can swing trade them in a week and have a lot of success that way, but I think that those people are few and far between. I think it's much more likely for people to kind of take a couple targeted shots on aggressive growth plays, and they can pay off for the right investor.
Will you trade an IPO on the first day?
I would never do it. No, I would not in a million years. I mean, again, I think that, it's a dirty little secret of Wall Street. We talk about how, equity markets are a great builder of wealth in the long term, and I truly believe that. But humans are not long-term creatures, right? Like, we want to get paid, and it's nice to think that you can buy a company on the first day and double your money. Maybe, possibly, I suppose it's academically possible, but I think that hearts are broken more often than not in those situations. I think it's awfully risky, and I'm one of those people. It's just my nature. I tend to limit my risks and limit my costs more than I try to shoot the moon, but, that's just me.
And then you'd like to take a look at the S1. Can you just tell us about, what that filing is and what you look for?
Sure. So again, when a company is private, they get to do basically whatever they want, and they get to disclose very little. In the process of going public, there's certain due diligence that must be done. So the SEC requires a document called the S1 to be filed. You get things like revenue trends and profit trends, not just of the moment, but they're also kind of, back tested, if you will, over the last couple of years. So you get to see trends as well as projections about where the company thinks they're going with guidance. Those can be fuzzy because you never know how a company is going to evolve, especially when it's fast moving. But I do think that directionally they can tell a pretty good story, particularly for companies that are not profitable and don't project to be profitable anytime in the near future. You have to understand what you're getting into. Again, I'm kind of old-fashioned and limit my risk that way. A company that's bleeding cash like crazy and is dependent on huge growth simply to break even. I'm not super interested in that. I suppose you can make money sentiment trading that, but either way, you should be completely informed about the company you're buying. You can't simply say, I like this name, I like this product, I eat at Shake Shack. It's
Right.
important to understand valuation and growth at the end of the day. I don't think sentiment is everything.
What's the S1 telling you about Fitbit?
I don't dislike Fitbit per se. I mean, this is one of those best of time, worst of time story. I think Fitbit's okay, and I think that there is upside in the whole kind of fitness wearables thing. That there may be acquisition potential. I don't know. The valuation just bothers me. I mean, it's like that in a lot of stocks, and I'm wrong on a lot of stocks like this. The valuation on Netflix bothered me to start the year, but it's doubled since then. So what do I know? But I think it's dangerous for companies like that. Again, it offered at 20 in June, and now it's at 42. You can say that perhaps Wall Street wasn't smart and they left money on the table. But in this environment, I think Wall Street is squeezing as much as it can from the IPO market. I find it very difficult to believe that that the book runners undervalued Fitbit by 50%. So who knows? I tend to want to wait for a couple quarterly earnings reports to see what the trends are with Fitbit. I think that it's a decent company, and I actually have friends that swear by the products, and that's saying a lot. I mean, I think the story is the same for a company like GoPro. GoPro undoubtedly has innovative products. I think they do have a lot of brand loyalty with consumers, but they're down 20% year to date because they got that initial IPO pop, last fall, and it was just too much too quickly. So again, that's perhaps too much information. I think I like Fitbit. I'm just a little leery of the valuation here.
What about the high-frequency trading firm that went public, Virtue Financial? What are you seeing in that issue? You looked at the S1 at all? It's actually done okay. Sold off a little bit out of the gate, but up near the all-time highs. What's your take on VIRT, Virtue Financial?
Well, I have to admit I haven't dug too much into documents there, but I will say that I'm concerned broadly about the idea of high frequency trading, just because it's not just the regulatory environment, but there's been a lot of research shown that it is kind of like it's a meaningless arms race between firms. There was money to be made, but now all the cash that needs to be deployed for investing firms to actually get an edge. I don't really know if that's much more than a fad, to be completely honest. So I would be concerned just about the long-term potential of a market that may not be as robust as some think it is. I think the IPO was certainly well timed, but whether or not that has staying power, I think there are broader forces at work. And again, that's one of these risks that you need to acknowledge with companies that are going public. Is some of them are going public at the right moment, but doesn't necessarily mean that it's a great company that's going to be around in 100 years. Some of them just have their moment. We saw that in the tech bubble of 2000, and we're certainly seeing that with some companies now. But only time will tell which companies are going to stick around and which ones were fads.
Tell us about your book. You're the author of the book, The Frugal Investor's Guide to Finding Great Stocks, 11 free resources to help beginners identify fantastic investments. I know we don't have time to go over all 11, but could you just highlight a couple of the key ones for us?
Yeah, I mean, I'm a firm believer in looking at the numbers and figuring out how things work. So basically, there's a whole lot of screenshots, tips for how to read a 10K or a 10Q to actually look at fundamentals to find earnings multiples to find price sales, price book. A lot of those ratios you see thrown around on the internet a lot, and I do quote them myself in the course of a 700-word article on Tesla. But I think it's very important to understand the fundamentals of a company. So my goal is to just give people some tools to identify these numbers via free screening on the internet. The internet is great that way in this world of data and all this access to financial metrics. You can do a lot for free on the internet if you just take the time and you know where to look. So it's kind of a roadmap, if you will, and how to dig into the numbers of the stock. Because again, I'm old-fashioned. I do think sentiment, momentum matters, but at the end of the day, show me the money. I want to see profits on the balance sheet, or else I'm kind of not interested.
Before I let you go, I mean, it's not really. It's been out for a while here, but what do you think of Twitter?
Oh, dude, I'm not buying Twitter. I love Twitter. I think it's a great tool for me as an information filter. But I'm not interested at all. I mean, the company hasn't been profitable. It says it's profitable, but that's because it quotes non-GAAP numbers. And its user growth is slowing, and it's this small mobile screen. And as anyone who works in digital media knows, advertising is a deflationary and highly challenged market. So I don't see where it goes from here, and I don't think Twitter really knows where it goes from here either, as evidenced by its kind of shake-up in the C-suite. So I'm not interested. I think, again, this is one of those companies that's super hot. There may be a sentiment trade there. You ride the peaks and valleys. But long term, I don't know. People speculate about Google buying that stock, but I certainly don't think with the earnings multiple that Twitter's trading at now, why would they? So the short answer is I'm not touching it. I don't like Twitter here, and I probably won't like it in the coming months either.
We've been on the line with Jeff Reeves. He's the executive editor of InvestorPlace.com, focusing on the IPO markets. Thanks a lot, Jeff, for coming on. We hope to speak to you again soon.
It was a pleasure to be here. Thanks.